Well, looking at the uncertainty in the market, DAM Capital has released a report identifying a bunch of themes for the market and, more importantly, stocks that it can believe are doublers in the next 3 years. Nandan Chakraborty, who is the head of strategy at DAM Capital, joins us now to discuss his views. Nandan, wish you a very happy new year. In the kind of uncertainty that we're seeing in the market, specifically in the very recent past, the mid-cap index coming off highs, a lot of stocks falling as well, a lot more from their 52-week highs. You believe that there are a bunch of stocks which can be doublers over the next couple of years. If you could, give us a sense of what gives you this confidence, and among those, what would your top picks be, even as the list flashes for our viewers on the screen?
I need a little bit of a preamble before coming directly into doublers. I'm glad you used the term uncertainty rather than volatility, because a lot of people say that the markets are going to be volatile this year. That makes no meaning, because volatility is something that may happen for 1, 2, 3, 4 months. The market usually is either goes up a lot or down a lot. It's never really volatile for a long time. So it's uncertain right now. So in uncertain times, there are two things that are important. One is you should have a margin of safety in your stock picking, and which is why we came out with the doublers list. And the second, as Nicholas Taleb keeps telling us, is that in uncertain times, you try to have a barbell market. Barbell portfolio stance. So you have a low risk and high risk sort of bets. So the second part is the reason why we've also given another this thing of large cap bets, which are more of a 1 year perspective. So the reason for the doublers is so that you have a huge margin of safety. So we took stocks which are more than 27% odd earnings CAGR for the next 3 years, and therefore you have a short list of those stocks which can double in 3 years. Then we've used our judgment to figure out those where the PE will not derate or re-rate too much. And therefore, we built this set of 14 stocks.
Okay, all right. Hi, Nandan. Good morning. Good to see you in. This is Nigel on this side. It's been a long while since we chatted, so good to have you on the show. Nandan, a couple of points you're making on the index itself. The fear is that Trump will be super for the US economy, super for US markets. Maybe Trumponomics 2.0 is as good as Reaganomics. So let's see whether or not that happens. And because of that, only the US markets will outperform. But you're making this point that the Indian market valuation-wise is trading at a 10% discount in comparison to the US markets. So that's why that could be another bottoming out sign, provided the US markets don't fall apart. Tell us more.
So again, I need two preambles. One is that the US markets and the Indian markets don't necessarily compete. They are the only two markets in the world among the major markets, which for if you take a long period of 20, 30 years, where both have performed well. There's almost no other market which has done that. Both of them coexist. The dynamics of the US market are very different from that of India. For example, the US market, tech dominates the whole thing. Any market where anything dominates is vulnerable. So it's not volatile, it's vulnerable. So it may or may not happen. So the US and the Indian markets do compete in terms of the flows, whether because of safe haven it goes back to the US versus it comes here, but they coexist because we are unique, and there's an entire section in my strategy which talks about why we are unique among all markets in the world. That's the first preamble. Second preamble is the fact that we have a number of uncertainties this year. One is climate change, which is the erratic monsoons which screwed up your inflation and therefore affected consumption. Number two, we have Trump, and therefore, because of Trump, you may have competitive devaluation of currencies across the world. Yuan, India, everybody included. And that is a major factor because, for us, the pressure on the rupee may come out of flows, may come out of competitive devaluation due to tariffs, and also the fact that he said that if we are part of the gang, which is unrelated to trade, but is related to currency management. And therefore, he may put some norms on us, tariffs on us, and so on. The third part is rates, which I'll get into a little more in detail because that requires detail. Number four is valuations are high in India. Whatever you say, in terms of the premium and so on, 1%, 10% doesn't really matter. Valuations are high in India, we must accept that. Then the fifth is consumption recovery and capex recovery in India, which we are expecting in the next 3 months. Finally is the wars. Now it's getting out of hand because Israel has said that basically next target will be Turkey. Putin is saying that the next, Belarus, if you don't join the war, then this thing, support you for presidency. So there are. So coming to rates, it's an important thing. This new RBI governor has a quadrilemma now. On the one hand, he has to manage what the Fed does. And the Fed is confused between inflation versus growth. Inflation has a lag of roughly 9 months. Growth has a lag of more than a year. So whether it's US, whether it's India. So that's a third is a Fed stance. Then he has to manage growth because growth is weak in India now. Number 3 is what we just talked about, which is about currencies. So he has to manage the currency also and growth, etc., also. And finally is inflation. Inflation has gone up in India because of 3 factors. One is the short term, which was the erratic monsoons, which has led to basically, fruit and vegetable prices and all that. Second is the medium term, which was due to GST. So GST cracked our entire SME sector. So that's led to a lot of unemployment. And therefore, inflation and so on. And the third is our lack of manufacturing capacity. So all these things, there are a large number of uncertainties, which is why I'm not making a case that the Sensex will either go up a lot or go down a lot. It is uncertain, and therefore my strategy is high margin of safety, therefore doublers and the large cap barbell.
All right, so let's talk about the two ends of the barbell, and I'm particularly curious about consumption, which you said is likely to recover in the next 3 months itself. So if you could tell us, what are the drivers you believe will lead to this recovery in consumption? Because managements are seeing demand to be still fairly uncertain. And in light of that, from a 1-year standpoint, you have Hindustan Unilever as a recommendation, which has been a bit of an underperformer in the past. Wonder what would, drive growth or returns here in the next 1 year or so. And the second one, which is the other end of the bubble, is Radico Khaitan. Yes, from a macro standpoint, everyone is fairly optimistic about the alcobev sector in India. Radico Khaitan has been quite an outperformer. What do what makes you so confident that this will be a doubler even after the outperformance that we've seen over the next 3 years as against the other options in this space?
Okay, so coming to consumption, so we're taking 2 ends. One is, I can't call Radico Khaitan a consumer durable anymore. It's more or less, a higher end FMCG and FMCG itself. The case for, and I can't talk stock specific, so I'll just talk about the segment. So as far as HUL and the entire FMCG segment is concerned, Rabi sowing in both, that is the winter crop, in both wheat as well as rice has gone up. And therefore, the hit that we had due to erratic monsoons, which affected inflation, that's going to ease in the next 3 months. So we expect inflation to start coming down in March 25 as the Rabi harvest comes on. So that's the basic theme for HUL and the others in terms of outlook, which is rural versus urban. Coming to Radico, I don't know if you all read the recent article in The Economist on the age group of 55 plus versus the younger guys. The younger guys in the West, are now very anxious and basically glued to their mobiles, whereas we, sort of 55 years plus in the West is basically still into the party mode. Coming to India now, the biggest delta in consumption is things like lending and devices and sins and so on. So that growth is tremendous and has been going on for long. And you talked about how much it's risen in the past. Well, if it is, it can cut both ways. I mean, history doesn't matter. How much it has gone in the past is not a reflection of the value that you have in a particular stock or sector.
Okay, all right, Nandan, appreciate you joining in and filling us in with your quick insights. It's an elaborate note that you put out there, and we enjoyed reading it. So we enjoyed you joining on the show and giving us a sneak peek into all those aspects. Wishing you all the best for 2025, and we look forward to chatting up with you more often.
All right.